Howdy, Jacob here. Today we're looking at Coca-Cola Europacific Partners in the beverages industry. 34 billion market cap on 42 billion enterprise value. Founded in 1904. They're a distributor of Coke products, and the revenue is very impressive. Looks like there might have been some acquisitions in 2016, 2017, but even outside of that, decent growth with pretty solid margins, pretty flat over the last 10 years on gross and operating side, but 12-13% operating margin is not bad. They do pay a dividend. It looks like it is over 50% of their earnings per share. We'll see what it is in relation to free cash flow, but that's a bit of a payout. Their return on invested capital is not entirely impressive. It looks like 5 to 7%, and so makes sense that they're paying this dividend because reinvesting appears to not be reinvestment rate doesn't appear to be too great. They have about $2.1 billion in cash-like products with 1.2 billion in short-term debt, 10 billion long-term debt. So that 10 billion long-term debt is quite a lot. And in relation to their free cash flow, it is, let's say it averages about 2 billion, even though it's quite a bit higher since the acquisition. Maybe 2.5 billion. So it's about 4 to 5 years of their most recent couple years free cash flow. So that ratio is not terrible, but I mean, I definitely prefer it be well under 3 years. But because debt, you can think about it's pretty similar to how you would think about as an individual. But I will say they have a good amount of cash on hand, very solid cash flow production, and the use of cash is pretty heavy on the dividend side. The dividend on a free cash flow basis pays out less than 50%, so that's good. They bought back a little bit of debt since their large issuance for acquisition purposes here, so that's positive. And then, yeah, I think I'm ready to start making some assumptions here. On the revenue growth side, probably wouldn't be surprised with 6%. And their enterprise value is quite a bit higher in market cap. I will assume that debt gets reduced a little bit, but let's go market average here. For margin wise, maybe 9 and 12% with share change of just off stock-based compensation pretty much. They do issue a little bit of shares too. So 1% would be about 300 million. They're not adding that much, but they're adding a little bit. So let's add that. And then the dividend, let's not increase that. I want them to, make strategic acquisitions, buy back shares specifically if things get cheap enough. But right now, I'm fine where that dividend is. And this dividend ratio, what have they done in the past? Pretty big increases. All right, so I'll increase it with their revenue growth, whatever. So this is saying the dividend is roughly going to be of just under 50% payout ratio, a little bit of money to acquisitions or reinvestment, and then debt reduction as well. So 39% drop before you get before you get to the return we're looking for here. Not terrible. Coke distributors are a very solid business. So when this gets to an interesting price, I'll definitely do a deeper dive. But for now, I'll just research other companies. So thank you and have a great rest of your day.